Hello and welcome again to Taxes in Retirement Live. This will be about required minimum distributions, or RMDs. We'll give people some time to trickle in here since it's 8:01 now. I will share a few dad jokes I have to kill a few seconds before other people join. Why did the Scarecrow win the Scarecrow of the Year award? Because he was outstanding in his field. Yep. I just did that. How much does corn on the cob cost on a pirate ship? A buccaneer, of course. And finally, if you're not already sickened by these terrible jokes, Dad says, "Doctor, I've broken my arm in several places." Doctor says, "Well, you probably shouldn't go to those places." Mm-hmm. All right, that's that. Those are my dad jokes. I do have a new microphone this week. Hopefully the sound is better. I tested it out before to make sure it didn't sound as canny and tinny and terrible as last time. If anyone's having problems hearing me, please let me know in the comments. But otherwise, I will assume the sound is better this week. So again, this is going to be discussing required minimum distributions. I will start by saying, and this sort of is the crux of why you want to do tax planning and why you want to try to minimize taxes in retirement. The statement and the balance you see in your tax deferred accounts like 401ks, IRAs, 403bs, etc., isn't entirely yours. Let's say you have $1 million in that account, good for you, but that's not $1 million you'll get to actually keep, because anything you see in those is actually a partnership between you and Uncle Sam. You may see it as an asset, but what those accounts really are just untaxed income. Technically, that's how the IRS views them. So when you do eventually take money out, you owe tax on it. Whether you take it out to spend it and pay for life, or you convert it to a Roth, you pay tax upon the conversion. The point is, any money that comes out of that is going to be taxed. So whatever figure you see as your balance in your 401k, IRA, 403b, it's not yours, not all yours. Part yours, part Uncle Sam's. The goal is to minimize the part that Uncle Sam gets, thereby maximizing how much of it you get to keep. It'd be really hard to keep 100% of it, possible in theory, but practically for most people, you're not going to be able to get away with zero tax on all of your tax-deferred income. But that's the gist. So that's how I want to frame this, and that's why RMDs, required minimum distributions, are in place. I just got a pop-up saying, how do I see the live stream? I assume it should be flowing in the timeline for everyone here. Can anyone watching please just comment, let me know that you do, in fact, see it. I know there's a 15-20 second delay, so it may take a while, but just confirm that you see it. If in 30 seconds I don't get any comments, then I'll assume I'm talking to a blank space and no one can see it. But I just want to confirm it is actually running on the group's timeline. So, with that in mind, the fact that your tax-deferred accounts are not entirely yours, they're not really your assets necessarily, they're just income that hasn't yet been taxed, the government eventually is going to make you take the money out and pay tax on it. The benefit of putting money in the tax-deferred accounts, obviously, is that the money you put in gives you a deduction on your income at the time. That's the benefit of why people contribute to 401ks and IRAs, but you're just kicking the tax can down the road. You're not, it's not a tax deduction, it's a tax deferral. That's the key difference, right? You're just deferring, kicking tax down the road when you do make contributions to these accounts. So the point is, the government realizes you got a tax benefit when you put money in. They don't want you to indefinitely delay having to pay tax on that money. So at some point in your life, they force you to start taking it out if you haven't already. Those forced withdrawals are called required minimum distributions, or RMDs. Now, up until January 1st, it used to be that any tax-deferred account you have, you needed to start withdrawing, if you didn't already, in the year you turned 70 and a half. That all changed effective January 1st due to what's called the Secure Act, which passed at the very end of December. It was jammed through kind of last minute under the radar, like the last week of December. I don't know if it was good or bad, how quickly they did it, but like, a lot of people were kind of on vacation and not really paying attention, and boom, all of a sudden there's this new retirement law. So if you turned 70 and a half prior to the end of the year, you needed to have started taking your distributions already, with one caveat, so hold that thought. For those of you that did not yet turn 70 and a half by the end of 2019, you don't need to start taking your distributions until the year you turn 72. Two caveats, actually. In either case, that first year's distribution you're required to take, you can actually delay up until April 1st of the following year. So let's use this year as an example. If you turn 72 at some point in 2020, you're supposed to take your first year's distribution this year in 2020, but you have the option to delay this year's distribution until up to April 1st of 2021. And then in 2021, in addition to having to take your delayed first year from 2020, you'll also have to take your 2021 distribution, and then you need to take a distribution every year thereafter for the rest of your life, up until you die, literally. The second wrinkle or caveat is that due to another piece of legislation called the CARES Act, which was passed in March, directly related to, it's an economic stimulus effort to try to help the pandemic issue, the economic effects of the pandemic issue. Under the CARES Act, all RMDs for 2020 are waived completely. You don't need to take them. So whether this is supposed to be your first year or your 40th year of taking these required distributions, you flat out don't have to. You can if you want to. The government will never stop you from taking tax-deferred money and paying tax on it. They prefer you did. But this year, you're not required to take that minimum amount under any circumstance. There was some wrinkles earlier in the year where if you already took it in January, for example, it was kind of tough luck. You weren't able to undo it. But as of last week or 2 weeks ago, time's kind of all running together in this weird world. As of not too long ago, the IRS did issue guidance that says, no, even if you took it in January 1st, let's say, you can undo it. You can simply just kind of put it back as if it never happened. Now, the mechanics of how to do that, I'm honestly not sure on. If that situation applies to you, work with your custodian that holds your account or your financial advisor if you have one, and figure out the specifics of the process you would need to do to put that RMD back if you want to. You can simply just keep it, no harm, no foul. You'll have to pay tax on it this year, but if you want to undo it, you can, thankfully, as of a week or two ago. Okay, so RMDs apply to all types of tax-deferred accounts. Again, traditional IRAs, not Roths. I'll say more about that in a minute. Traditional IRAs, 401ks, 403bs, 457, which is sort of like 401k, TSP, which is a federal plan, again, loosely similar to 401k. And if you have a small employer IRA, what's like a SEP, SEP, or a simple IRA, either of those are also subject to required minimum distributions. Again, because they're all tax deferred, you need to start taking money out and paying tax on that money at some point. If you have multiple IRAs, let's say you have 2 at Fidelity, 1 at Vanguard, 1 at TD Ameritrade, you're allowed to aggregate the balance. Actually, hold that thought for a second. Let me go through the formula to calculate the RMD, and then I'll touch on this aggregation idea. So anyway, so all tax-deferred accounts have them. Roths do not. If you have a Roth IRA, because you already paid tax on it when the money went in, and because under most circumstances you're not going to be taxed again as it grows or when you take it out, the government doesn't force you to take it out. There's no benefit to the government for you to take out Roth money because you already paid tax on it. So Roth IRAs do not have to be mandatorily withdrawn from. Separate story, if you die and someone else inherits it, I'll touch on inherited accounts toward the end, but if you're the Roth IRA account owner, no required distributions from it. All right, so how do you calculate what the RMD is? Now it's time for my cheesy, held up in front of the screen slides here. And again, feel free to ask questions, post comments in along the way. I see there's nothing yet, but definitely if you have something, don't hesitate to stop me. So The RMD you calculate for any given year is going to be a function of that account's balance as of December 31st of the prior year. See if I can get this in frame here. Font's a little small, apologies, but so for example, for this year, to calculate your RMD in 2020, again, assuming there wasn't the CARES Act that says you don't have to take it. Let's just go back to the world where, where you do. It's going to be the balance of your account as of December 31st of last year, so 2019 in this case, divided by what's called the distribution period or distribution factor. So this is pretty self-explanatory, right? You can get that from looking on your statements or online or whatever. You can easily find out, again, December 31st of the prior year is the account balance you use. It doesn't matter how high, how much the account's gone up or down since then. It's the December 31st last year value that you use. So next question, what are these distribution periods? In most cases, you're going to use a factor from what's called the uniform lifetime table. And this is all available online. You can just Google this stuff. This is nothing proprietary here. You can find this many places, readily available. All you basically do is you look at your age in the year of the RMD and take the factor next to it. So let's assume you're 72. Let's make sure I still have this in the screen. So assume you're 72 this year. Your factor would be 25.6. Okay, so now let's go back to our other example. Let's assume you're trying to calculate your RMD for this year. You would take your balance as of December of last year, December end of last year. Let's just assume it's $1 million for nice even numbers. Divide that by that factor we just looked up. For 72-year-old, that factor is 25.6. That's your RMD for this year. What is that? I'm looking upside down here. $39,062.50. So if we did not have the CARES Act that waived all RMDs this year, and you were turning 72 this year, and you had $1 million IRA or 401k or whatever as of $1 million as of December end last year, you would need to take out at least $39,000 and change this year. That's your RMD. Now, just one interesting thing here. So going back to this table, every year you get a little older, your factor goes down a little bit. Now, technically it's these factors that are used, but you can also sort of loosely equate it to percentages because that sort of, people can better visualize that. So I took the liberty of changing it to percentages. So at 72, for example, you would need to withdraw approximately 3.9% of what your account balance was as of December end last year. And then as the factors get smaller, the percentages get larger. All the way up until, let's see if you can see this here. God willing, if you reach age 115 and over, every year you need to take out at least 52.6% of whatever your account balance was the prior year. So every year they force you to take out more and more and more in percentage terms, all the way up until age 115, at which point it's you're basically taking out half of your account every year at a minimum. Okay, so this is a uniform lifetime table. Most people are going to use this to determine their RMDs. There is one other table that comes into play, specifically only if the sole beneficiary of your account is your spouse, and your spouse is more than 10 years younger than you. So like 12 years younger, 15 years younger, or whatever. In that case, again, spouse is sole beneficiary, and spouse is more than 10 years younger, you're going to use a different table. It's called the Joint Life and Last Survivor table. Now, I only made a quick little snippet here because this table's a monster. Unlike the other table, where all you're looking up is just your age and the corresponding factor next to it, this one has two, you look along the column for your age and down the row for your, I got those reversed, but whatever. You look up your age along one side of the table and your spouse is along the other, and whatever that intersection is, that's going to be your factor. So this is just a small table. These tables go from like 70 to 100 plus on both axes. So I just did a small little snippet here. But for example, if your age was 72 and your wife was 61, your factor would be 26.3 this year. You can see that. So you find yours, you find your spouse, boom, the intersection is your factor. So again, this table only used if spouse is sole beneficiary and spouse is more than 10 years younger than you. Got it? So that's how you calculate it. Do you have to do it yourself? Not really. It's good to know it and it's good to check it. But to my knowledge, all custodians that hold your accounts, Schwab, Fidelity, TD, Vanguard, E-Trade, whatever, they all do this for you, or they should. If you have some really small, kind of unheard, not too robust custodian or broker, maybe they don't, but I think all the names you've heard of should do this calculation and provide it each year. Now, they may not necessarily flag you down to make sure you take it, but they at least tell you what it is. To the extent you do work with an advisor, he or she should definitely, this should be a fundamental part of what they do in providing a service is not only notifying you of your RMD, but also working with you to make sure you take it. And I'll explain what happens if you don't at the end. Very steep penalty. You can also calculate it yourself. Again, these tables you can get anywhere. I've made them myself in Excel. I have them hanging up on my wall. But there's lots of calculators out there. You can easily just plop in your age and your account balance as of December end, and it'll tell you what your RMD is. It's not that difficult, the math behind it, that is. Few other things to know. I started saying before, if you have multiple IRAs, so whether you have 2 or you have 10, doesn't matter, you do not need to take an RMD from each of the individual accounts. All of your IRAs their balances can be summed together, and then you could take one RMD out of just one of them, or a combination of any. But the point is, you don't need to take a separate RMD from each account. If one has a balance of 10,000, one has a balance of 100,000, that's combined 110. You can simply take one RMD from either of those accounts, so long as that RMD satisfies the requirement on the combined balances of those different IRAs. Make sense? A few exceptions. You cannot, if you have an inherited IRA, so one you got from someone else who died and left it to you, you cannot aggregate that inherited IRA with your own IRAs, because technically inherited IRAs aren't yours. They still belong to the person who originally owned it. You're just the recipient of its income. So because it's not yours, you can't aggregate that with your own. There's a separate RMD associated with that, and I'll touch on inherited accounts at the end. So all your IRAs can be aggregated except inherited. If you have employer plans, you cannot aggregate employer plans like a 401k with your IRAs or vice versa. So you have 3 IRAs, 1 401k, and let's say 1 403b because you're also a teacher somewhere. You can aggregate your 3 IRAs, take a single RMD to satisfy all 3 of them. You have to take a standalone RMD from your 401k based on its balance, and then another RMD from your 403b based on what its balance was at the end of December. So this is one of the positives of rolling all of your different accounts into one single account. To help, not only is it less passwords to remember, less statements, less potential mess for your heirs to deal with after you're gone, but it's less RMDs to track. Instead of having to take a 401k, a 403b, and then 1 to 3 different IRA RMDs, if you roll your 401k and your 403b into an IRA, or even combine all those IRAs into one, now you only have one account that you need to monitor and track and take RMDs from. So it provides a lot of convenience and ease and simplicity in your retirement planning. Now, many advisors, a lot of which are paid on the size of your investable assets, they can't charge you, in most cases, they can't charge you on money in your 401k. So historically, a lot of advisors said, yeah, sure, rolling it over into an IRA, that's the best thing to do. And in many cases it is, to be fair. There's a lot more flexibility, fees are often better, and this whole consolidation and streamlining thing, like I said, is a real benefit. There's value to that. But point is, sometimes some advisors would tell you to roll it over simply because they can charge you more when your money's in an IRA versus if you only have some in an IRA and the rest in a 401k. They can't charge you on the 401k. Just something to think about. Let's see what else. So you can do that for any employer plans. You can, in theory, roll over to an IRA, so you don't have all these different RMDs to have to track. Now, there's in some cases, it could be beneficial to leave it in your 401k. So there's an exception to having to take RMDs at 72 with employer plans like 401ks. And I don't know that this applies to all types of plans like 403bs, TSPs, 457, I'd have to check. But definitely with 401ks, if you're still working there and you're over 72, you do not need to take an RMD. You can delay RMDs just from that account, just from that 401k. This doesn't apply to IRAs to the extent you have any, just a 401k. If you're still working at that employer, whose 401k it is, whether you're 72 or 82, you don't need to take an RMD from that account so long as you're still working. Now, there's one other twist, like you can't own more than 5% of the business. If you do, that rule doesn't apply to you. But in most cases, assuming you work at a relatively large company and you're still working beyond 72, you can leave money there and not have to take it. So that may be one reason why you'd leave money in a 401k instead of roll it out if you wanted to prolong RMDs just from that account. Something else to think about. So that's aggregation. Inherited accounts. Now these are, any questions about that so far? I'm kind of done with my bit about RMDs from your own accounts. Now we'll move on to inherited accounts, which play under different rules. Super exciting stuff, I know. So when you inherit an account, someone has an IRA, has a 401k, they pass away. The rules for how and when you have to take minimum distributions out of inherited accounts also changed effective January 1st under the Secure Act. So now, if you inherit an account and you're the account owner's spouse, you have a few options. You can simply fold that account into your own as if it was your own, and then it plays by the rules I just talked about for your own account. You could stretch it out over your life expectancy, and there's separate data, I don't have it in front of me, but there's publicly available data that says for a 60-year-old person, you need to take, similar to that table, there's a factor type thing. You need to take out a certain amount for every age you are up until death. You have that option, or you can just take it all out in one lump sum. Now, in most cases, that's probably not beneficial, but you can just simply, you inherit $1 million from your deceased spouse, you can take it all this year, pay tax on it all this year, then go have a crazy massive party or something. I don't know. But the point is, spouses have a lot of, they have the most options of what they can do if and when they inherit an account from a deceased spouse. If you're not a spouse, whether you're a child, just a friend, a cousin, whatever, in most cases, now you're going to have to distribute it all within 10 years of the year of the person's death. You can do it all on the first day, you can do it all on the last day, the 10-year period, or you can dribble it out in any form or fashion you want along that 10-year period. There's no, unlike your own account where there's this actual formula and factors of how much you need to take out, when you inherit, you just need to empty the account out within 10 years, period. And you can do it at your leisure, however much you want to do. So they're not, I don't think they're technically RMDs in that case. It's just simply, you got this account, you need to drain it out in 10 years, done. So that's for most people that aren't spouses. There's a few exceptions. Prior to the new Secure Act, last year and earlier, non-spouses used to be able to stretch out the distributions. So like a 40-year-old person, if they inherited an IRA from a parent, they had a period of, it was like 43 or 44 years where they needed to you could take it out sooner, but at a minimum you needed to systematically take out a chunk of it over the course of 40-something years, 43 or 44 years. That's called the stretch provision. It allowed the recipients, the beneficiaries, to stretch out taking the taxable distributions from inherited accounts. That stretch provision mostly went away with the Secure Act. Again, spouses can still do it, or spouses can make it their own. There's only a few other classifications of people who can still stretch it out over their life expectancy. It's disabled persons, it's children, the deceased children, so long as the child is under the age of majority, which depends which state you live in. It's like 18 to 21, depending on the state. You can still stretch up to that point, and then once you hit age of majority, you need to take it out, the remainder within 10 years. If the beneficiary is less than 10 years younger than you, he or she can still stretch it out. But otherwise, if you, for example, you're a grandparent, you leave an IRA to your grandkid, they need to take it all out within 10 years. Only your direct child has the ability to stretch it out until they're of the age of majority. If it's a grandkid, it doesn't matter. They don't qualify for that stretch eligibility. That grandkid needs to empty it out within 10 years. So maybe you don't care. I mean, you're gone from this world. Frankly, it may not be your concern. Who gets, well, not who gets the money, but the fact that they have to pay tax means they got money that wasn't theirs. So like, you may not shed tears for them. Like, you just got something for nothing. You have to pay tax on it. Not that big a deal. But for those that do want to plan around, are there any? I don't see any comments here. I'm just checking. Sorry. I don't know if people didn't actually post comments or they're just not showing up. But I do not see any comments here. Hold on, let me just move my screen around, make sure I'm not missing anything. No. Apologies if people are posting comments or questions. I'm scrolling down, I'm clicking buttons, and I don't see anything. Where I would normally see, let me see if I can post one. I just posted a comment that says test comment. If anyone can see that, perhaps reply back to it. Checking something else here. Yeah, I don't know, weird. Just looking to see if there's something maybe that I needed to flag to allow comments. I don't think so. All right, well, super sorry for anyone who's been posting comments. If you have, I don't see them, and I don't even see where they may be hidden. One second. Someone just told me I have comments disabled. I just want to see quickly if I can change that. I don't know. Might not be able to after the fact. Here's what I'm going to do. I was going to say I was going to cancel the stream and then reopen it, but that may wipe out all of your comments. Yeah, all right, so let's do this. What time is it? It's 8:30. I'm going to cancel, I'm going to stop this stream, and I'm going to restart. So you all should see another stream pop up, and I'll be sure to when I do restart the next one, to actually flag on comments. I don't know how or why I missed that this time. So then I'm almost done with what I wanted to say here, so we'll have lots of time for questions. There's just one more thing I want to mention about let me do that now quickly while I'm here. So the last thing I want to comment on, then I'll close and restart so you all can ask your questions, is what happens if you miss an RMD you're supposed to take. So it is a really steep penalty. The amount of RMD you're supposed to take, the amount of RMD you're supposed to take but don't is subject to a 50%, 50% penalty. So back in our example where your RMD on your $1 million portfolio was $39,000 and change, if you don't take that or any of it, that's almost a $20,000 penalty you'll have to pay that year for not taking it. Thankfully, the IRS is actually pretty lenient with waiving it. There is a process to get it waived, especially if it's your first time, you just turned 72, or you just inherited an account and don't know what to do with it. You're supposed to take it, but they usually don't hold it against you. When you file your tax return, there's a form where you fill out your penalty amount. You can attach a letter with it that says, sorry, I didn't know, here's why. You basically have to express reasonable cause why you didn't know or couldn't have done it, like, I don't know, you were in an accident or something and in a coma for the last 6 months of the year and couldn't take your money out. That's completely excusable and the IRS will waive it. But if you repeatedly, year after year, forget to take or neglect to take your RMD, the IRS is going to stop cutting you breaks and they will slap you with this 50% penalty on the amount you're supposed to take. So do not mess around with RMDs. You definitely want to take them when you're supposed to. You can take as much as you want. Again, you can take out your entire account in one day, but at a minimum, the IRS makes you take out certain amounts. All right. So that's all I wanted to say. I'm going to stop this stream and immediately restart another one. And the other one I'll be sure to flag on comments. I clearly must have blocked them. Sorry about that. So for those of you that have questions, you may have to re-ask and repost them. Apologies. But those who want to ask things, stay by your computer. Stick with me. I'm going to stop this stream now, and I'll immediately start a next one right after that in like 10 seconds or so. So I'll see you soon. Hold on.